What's up, everybody? Today was a very volatile day. If you guys follow me on Twitter, I was throwing out trades all day. We threw out Mara, which is up like 12%. Bitcoin's ripping after hours. Did an update on Tesla. But what I want to do in this video is more so go over the weekly chart, and I want to go over some smart money concepts. We're going to talk about the weekly order blocks that are set in. I want to talk about why 212 is so important and what's going to happen if we break that. And I'm more so going to go over my plans on what I want to do as far as hedging my long-term shares, and if I plan to sell cash secured puts or add to my long-term position once it starts dipping, and I should say if it starts dipping below where my current price is long term. My name is Pete DiCarlo. I've been trading full-time for the past 9 years. I run a trading community with over 12,000 members in it. Go check out the Discord. All of our resources are free over there and on my Twitter. So let's talk first by looking at Tesla on the weekly chart. The indicators that we're going to be running is only one at the current moment, and it is going to be smart money concepts. So you're going to go to your indicators tab and you're going to type smart money concepts. And the one that I like to use is Lux Algo. It's free. I have no affiliation with them at all. It's just solid. Now, the only thing that we're going to do is come into the smart money concepts and we're going to go into our settings. And from here, we're just going to add one thing, which is to show the fair value gaps. So now you're going to be looking at something like this. And if you're a trader and you understand, order blocks, this is going to make a lot of sense to you. If you're a long-term investor or somebody who's kind of wishy-washy in the middle, you need to be paying attention to this stuff. This isn't like, I don't want to say like, it's not BS technical analysis. This isn't small levels that you should be watching 5-minute charts. Like, these are major institutional levels that usually respect these massive fair value gaps and usually respect these massive orders. So if you care about your positions, you're going to want to at least be looking at a weekly chart of whatever stock you're invested in to at least understand where it's going to be heading, and that if you want to potentially add more Tesla down at 160, you should know that there's a pretty high chance that's going to happen in the next couple of months, and maybe you can move some funds around, or potentially look to just know that in the future there's a high chance you're going to be buying more long term. So the two major things that we're going to be looking at, like we said, first is going to be order blocks, and that's going to be these red blocks that you're going to see here, as well as these blue blocks. The red blocks are bearish order blocks. They are institutional levels of selling, and the blue ones are going to be bullish order blocks, which are institutional levels of buying. And we're going to talk about respecting the level and understanding if we're going to reject or potentially move through it. Now, the second thing we're going to talk about is a fair value gap, and a fair value gap is going to be this red thing that you see here, as well as this blue thing that you see here. These are very important because they usually show big pushes up and big pushes down where there was liquidity gaps, meaning that there wasn't enough time for big money to fill on the positions that they wanted. So in most cases, we will retrace back into those gaps so that they can therefore fill into the positions that they wanted from the beginning. There's no actual price gap like you would see on just a candlestick chart, but these are very, very important, which is why we want to make sure that these are turned on. You will also see on your chart this CHOC, which means change of character, and these act as resistance and support levels that if we break through them, normally the trend will start to redirect in the opposite direction. So you can see that once we had this change of character break here in May of 2023, we closed over this level of 217, which indicated the change of character or the trend reversal. And from there, we obviously pushed up into this resistance level, which was a 36% move. We saw this rejection on this order block, and you can tell that we respected it because on the weekly, we actually pushed into it, but rejected fully and closed at low of the week. That is a very strong sign that this respected that order block. We pulled down, bounced at this level, which was change of character before, pushed up, rejected at 280, and now quickly moved our way down to 211, which, as you can see, we have another change of character sitting here at 212. So if we give up 212, Tesla will, in my opinion, definitely drop to at least $160 maybe 190. This is like the first level I'm really looking at. But the real thing we have to be looking at on this bigger time frame on the weekly is going to be that level of 160, because we're under this trend line support. If we break the change of character, that's not a good sign. We will, move down to 160, which I'll say is also where we had the swing low to swing high here. So if we move down, we could bounce off of 160 momentarily, but we also have this fair value gap at about 152. So what I think is probably going to happen is, worst case scenario, we're going to see Tesla break, hold under 212, confirm the change of character, which we have right now, move down to 160. Most likely from there, I'd assume that we would get some sort of bounce and then a further move either down to lows of 150 and starting to diverge. I don't know if we're going to get down to like $100, but I'm more so watching to see this potential move and then a test back up with 210 maybe in January of 2024. So where does that leave me as a Tesla bull long term? Well, it means that I'm going to need to open up some sort of hedge position. If you watch this channel or follow me on Twitter, you know that I opened up a hedge position on my long terms. Going into earnings, I closed it out for a stellar profit, but I have been holding off briefly because I want to make sure that we don't dead cat bounce here. Because something that we haven't seen yet is we could see that dead cat bounce. We could actually see the bounce here, come up to 233, and catch all of the retail bulls thinking that now we're going to push up to all-time highs again and that was the bottom, etc., and then flush our way back down to 160, which I do think could happen as well. There is a lot of manipulation and a lot of noise when it comes to Tesla stock, which is why I invest in it long term, but I do not really trade it much. But even if we go from swing high to swing low with our Fibonacci retracement level on that weekly chart, look at where the Fibonacci golden zone sets up. Right here between 235, which would also fill that fair value gap. Right now, we do have futures that are up, not drastically, but futures are up. Bitcoin's running. I wouldn't be surprised if we push our way back up and then make that subsequent move, as stated before, back down to like 190. But I do think 190 and 160, that's going to end up happening. So my plan to go short, to cover my position and at least stick a hedge in, is going to be, if we hold under 210 this week, I will definitely put my put position in. And if we don't, then I'm going to wait for the push up to 230 and go short. So it's either 230 go short or confirm under 210 go short. But no matter what, I'm going to be going short just to cover my long-term position. Now, what happens if this breaks and you're looking to get in long term, or maybe you're somebody who has some cash on the side and you're thinking that you want to add more? What would I personally be doing? Well, the first thing I would say is consult with a financial advisor, because I am not one. I'm just a dude on YouTube. But my average is around 202.52. So I don't really want to add much more to my Tesla position, to be quite honest, because I really think the next 3 years is going to be rough. I'm just going to be objective here. Depending upon how things go, I don't want to be over leveraged into this. But if Tesla moves back down into the 160s, the 140s, the 120s, I want to take advantage of being able to get some shares. So my plan is, like I said, we will open some put positions and we will ride it down to about $160. From there, I do not plan to try to continue to ride puts from 160 down to 100. Just don't think the risk is worth the reward. What I would be looking to do is, once we start to get down into this 160 level and we start to approach this big money block, what I will do is start to sell some cash secured puts at like 140, sell some more at about 130, sell some at about 120. So for those of you who do not know what cash secured puts are, if you want to take investing seriously, I highly recommend that you take the time to do it. We have trading resources that are free about options and selling puts over in our community, in our Discord, and I also do live streams all the time with the team going over how to sell cash secured puts. Basically what happens is, as a stock is approaching a price that you would actually want to own long term, you can sell a cash secured put or sell a put to a bear at a price that you want to own it at. So let's say that it's trading at like, $212 right now. Well, it wouldn't be worth it to sell it that low. But let's say Tesla's down trading at 170. And I'm like, all right, we're coming close to this bullish order block. We should fill the fair value gap pretty soon. I want to start a long-term position in Tesla at 150, and I don't want to be a stickler about when I get in. What I would do is I would sell a 140 or a 130. And what that means is that as long as Tesla closed above that price by my expiration date, I would make an income based on the premium. So you can make a couple extra $1,000 a month depending upon how much capital you have just by selling cash secured puts on stocks that you want to own for the long term. And the beautiful thing is, let's say that happens and Tesla's, it's sold off and it's trading somewhere within this level. As long as it doesn't close below your strikes, you're fine. You'll end up making money each and every single week, and you'll most importantly be taking money from the people who are buying YOLO options, because you're going to be money off of volatility. If you guys want me to do a video on this, comment down below. I can do a standalone video or a live stream with you guys about it. But what happens, right? What happens if we get stuck under there? Well, in this instance, if it's sold off, we started selling 140 puts and we're just sitting here and it craters. Worst comes to worst, we just get stuck buying shares at these prices. So maybe I get stuck buying 300 shares of Tesla, one at an average of 140, one at an average of 130, and one at an average of 120. It's not the end of the world. I want to own the company long term anyway. And then if I get stuck with those shares, what I can do, and I can explain this in a further video as well, I can start to sell covered calls on those shares up here. And what that would do would mean that as long as Tesla closed below my covered call price, I could wheel strat out and I can make consistent premiums every month just off of doing a wheel strategy. If you guys want a further explanation, we can talk about that in another video. But I hope that this helps, guys. I just want to talk about the bigger time frames, talk about the setup, and overall, we'll see how the next couple of days go out. Thanks for all the support. I'll see you guys next time. Peace.